Hello everyone, welcome back to my YouTube channel. In the last class, we studied about accounts from incomplete records. In that, we learned statement of affairs method. That is one of the method to determine or ascertainment of profit or loss under accounts from incomplete records. So in today's class, we are going to learn one more method, that is conversion method under accounts from incomplete records. It helps us to determine the profit or loss. Let's start it. So see here, most small businesses do not maintain proper double entry system, right? They only keep cash book, personal accounts or any partial records. So when full records are not available, we convert incomplete records into complete double entry system. Listen very carefully. When full records are not available, we convert incomplete records into complete double entry system. That is known as conversion method. See, as the name only suggests, conversion method. Convert incomplete records into complete double entry system by preparing trading account, profit and loss account and balance sheet. So what is the meaning of conversion method? We convert incomplete records into complete records by preparing trading account, profit and loss account and balance sheet. In double entry system, we prepare trading account, profit and loss account and balance sheet, right? So this is what conversion method. So it is just like double entry system. Means in conversion method, we try to reconstruct missing accounts. We try to reconstruct missing accounts. Clear? Now let's see the steps in conversion method. How to calculate the profit or loss. So in that step first, it is prepare opening statement of affairs. First, we prepare opening statement of affairs to find out the opening capital. Clear? Like statement of affairs method. In that also, first we will prepare opening statement of affairs to find out the opening capital. So the formula is opening capital equals to opening amount of assets minus liabilities. So this helps us to know capital at the beginning of the year. At the beginning of the year. This is the first step. Clear? Now second step is prepare missing accounts. Now we need to, this is the very important step. So these amounts are useful to prepare the trading account. Clear? So in that second step is prepare missing accounts. So we prepare missing accounts like total debtors account, total creditors account, bills receivables account, bills payable account, cash account and bank account. So these accounts helps us to find credit sales. These accounts helps us to find the total amount of credit sales, credit purchases, cash received, cash paid. Clear? So all these accounts we need to prepare. So these amounts are useful when we preparing the trading accounts. Clear? Now let's see that let's discuss about the total debtors account. So see here, from debtors account, from debtors account we find credit sales. We find credit sales. If we prepare the debtors account, we find out credit sales. Clear? Debtors means customers who owe money to the business. Customers who owes money to the business. Clear? So we can find out the total credit sales amount. So here credit sales, it means what? It means selling goods to the customers without receiving cash immediately, but payment is received later. Credit sales means selling goods to the customers without receiving cash immediately. Means they will not pay the amount immediately, but the payment is done at a later time. That is what credit sales. If we prepare the debtors account, we are able to find out the credit sales. Clear? So I hope this is clear to you all. Now let's see the format of total debtors account. Write down date particulars, JF amount, date particulars, journal folio and amount. Here debit and credit. Clear? First what we need to write down? First we need to write down to balance brought down. To balance brought down means these are customers who already owe money to the business. Clear? To balance brought down means customers who already owe money to the business, means amount receivable from customers at the beginning of the year. That is what to balance brought down, at the beginning of the year. Clear? And go to the credit side, write down by cash received, means cash received from the debtors, means when customers pays the cash, debtors reduces. Clear? When customers pays the cash, the total amount of cash received we need to write down on the credit side. So the debtors reduces, right? And second one, it is by bank, means payment received through bank or check. And next one, discount allowed, means discount given to the customers. Then customers pay the less amount. Comes under credit side. Again debtors reduces. By bad debts means that is amount not recoverable from the customers. That time also debtors reduces. And sales returns means goods returned by customers. That one we need to enter on the credit side of the debtors account. And by bills receivable account means when debtors gives bills, the debtor account decreases. When debtor gives the bill, the debtor account decreases. That comes under credit side. So the here technique is debit side increases debtors and credit side decreases debtors. See, credit side decreases debtors. You need to remember this technique. In debtors account, credit side decreases. See, cash received means our debtors reduces. Bank, they are paying through the, they paid, already paid through the bank. Discount allowed. Discount given to the customers. Then customers pays the less amount. Bad debts, that is not recoverable from the customer. Sales return, goods returned by the customers. And bills receivable when debtors give the bill. So these all are means in this debtors reduces. So it comes under credit side of the debtors account. Now here we need to write down balance carried on. Here write down by balance carried on. Here write down by balance carried on means the amount receivable at the end of the year. Means these are the customer who still owe money. These are the customers who still owe money. Here balance brought down means amount receivable from the customers at the beginning of the year. And here by balance carried on the credit side, amount receivable at the end of the year means these are the customer who still owe money. Clear? Now we will go to the debit side. First one to balance brought down, you know that. And second one it is to bills receivable, bills dishonored. Bills dishonored. It means what here? Bills receivable, bills dishonored means when customers gives bills receivable but later the bill is not paid. Then the amount again becomes debtors. Means here increases the debtors. Debit side increases debtors. Clear? Bill dishonored. The bill is not paid. Clear? So after that to credit sales means this is the balancing figure. Means credit sales means selling goods to the customers without receiving the cash immediately. Payment is received later. Clear? This is the balancing figure. So if we prepare the debtors account, we will get credit sales. We will get credit sales. That is our balancing figure. Clear? I hope this debtors account is clear to you all. So if we prepare in the step second, we need to prepare the missing accounts. In that first one is debtors account. If we prepare the debtors account, we are able to get total credit sales. So here the technique is debit side increases debtors, credit side decreases debtors. Clear? That's it. So now let's see the example for total debtors account. See here, total debtors account. The following information is obtained from the books of Mohanlal Traders. So debtors on April 1st, 2025 is 50,000, means to balance brought down. And debtors on March 31st, 2026 means 70,000, means by balance carried on. Cash received from debtors means debtors reduces. Go to the credit side and enter, that is rupees 60,000. And discount allowed to the customers will pay the less amount, means debtors reduces. Go to the credit side and enter discount, that is rupees 1,000. Bills receivable, that is 30,000, but here they are not mentioned about dishonor, so we assume that it comes under credit side. Paid by the customer, that is rupees 30,000. Bad debts means amount that is not recovered from the customers, means again debtor reduces, that is rupees 3,000. Clear? So see here, to balance brought down 50,000, by cash 60, and discount allowed 1,000, bills receivable 30,000, and bad debts 3,000. And here debtors on March 31st, 2026 by balance carried on 70,000. Here 70,000. Now here on the debit side only to balance brought down. Now we need to calculate. Here the total it is 1,64,000. 1,64,000, right? 60,000, 1,000, 30, 3,000, 70,000. Yes, 1,64,000. Here minus deduct 50,000. Minus 50,000. Then we will arrive credit sales. That is rupees 1,14,000. That is our credit sales. Clear? So in this way we need to prepare the debtors account. Then we will get credit sales amount. Clear? Now in the step second we prepare the debtors account. Now next go to the total creditors account. If we prepare the total creditors account, then we find credit purchases. If we prepare the debtors account, we are able to find out the credit sales. Remember, and if we prepare the creditors account, we find credit purchases. Credit purchases, creditors account, creditors. It means what? Creditors, it means they are the suppliers to whom business has to pay money. Because why? Creditors means the suppliers, business has to pay the money because goods were purchased on credit. They will, means business, they will pay the amount at a later time. That is what creditors. Clear? First, let's see the format, how we need to prepare the creditors account. See here, first here on the credit side, debit, credit, by balance brought down, it will come. Creditors means the suppliers, clear, to whom business has to pay the money. On the credit side, we need to write down the by balance brought down, means opening creditors, amount payable at the beginning of the year. Old unpaid suppliers. Clear? Now next one, by bank, means checks dishonored, checks issued to the creditors but dishonored. But dishonored means not paid. See, this is exactly the opposite of debtors account. Right? So on the credit side, increase creditors. And by bills payable, bill dishonored. Again, bills payable accepted but not paid means liability increases. By credit purchases, that is the balancing figure. Now let's go to the debit side. To cash paid means debit side decrease creditors, decreases the liability. Clear? Any one account you need to remember, debtors or creditors. That is just exactly the opposite of debtors or creditors. Clear? To cash paid to the suppliers means liability reduces. And to bank, check issued, payment made through bank or check. To bills payable, bills accepted here. When we accept bill in favor of creditor means credit account reduces. Creditors account reduces. To discount received means suppliers gives discount. Then business means we pay the less amount means liability reduces. To purchase return means goods returned to the supplier. Business they will return to the suppliers. Goods returned to the supplier. Amount payable reduces. Next one, to balance carried on. To balance carried on means amount payable at the end. Means still unpaid to the suppliers. Clear? So, and here we will get on the credit side, we will get credit purchase amount. That is our balancing figure. See, debit side decreases creditors and credit side increases creditors. Clear? So, now let's see one example about creditors account. See here, consider the following transactions relating to Kisan food suppliers. Opening balance of creditors means by balance brought down 40,000 and closing balance of creditors to balance carried on 50,000. Payment made in cash. Where we need to enter cash. Cash paid 85,000 debit side. Liability reduces. That is 85,000 and discount received. Discount given by whom? Suppliers to the business. Then business will pay the less amount. That is rupees 2,000. Clear? Now the total of these 1,37,000 deduct 40,000. Then we will arrive credit purchases. Credit purchases, that is 97,000 rupees. 97,000, that is our credit purchases. Clear? So I hope these both accounts are clear to you all. If we prepare the total debtors account, we will arrive credit sales. If we prepare the creditors account, we will arrive credit purchases. Credit purchases. Clear? Debtors account, credit sales. Creditors account, credit purchases. Any one format you need to remember. If you remember the creditors account, so debtors account, that is exactly the opposite of creditors. Clear? So you need to follow this technique. For creditors, debit side decreases, credit side increases creditors. And debtors account exactly the opposite. Debit side increases debtors, means bills receivable but bills dishonored. And credit side decreases debtors, means cash received or payment done through the bank, discount allowed, bad debts not recoverable from the customer, sales return, bills receivables. Clear? So I hope this class is clear to you all. Here today we discussed about step 1 and step 2. In that step 2, total debtors account, total creditors account. Clear? It is clear to you all, right? So in the next class we will discuss about bills receivable account, bills payable account, cash account and bank account. So if you have any doubts till here, please leave a comment. Thank you.